In this week's update, momentum in precious metals, how to mitigate risk in tricky markets, and the opportunities remain abundant. My name's Garry Davis, and as always, this is general advice only. And please remember to subscribe and like the video. All right, let's start with the overall perspective. It's a pretty tricky time, and we saw a significant fall on Monday in the US in the last 2 hours. The market was actually rising throughout the session, and then I think it may have been related to the reimposition of lockdowns in California, and that was just enough of a trigger to send what was a bit of an overheated market down, and down quite concertedly. The major tech stocks were sold off heavily on big volumes, and it really did look like it could have been, the market could have been rolling over into what is probably a bit of an overdue corrective period. So the main issue that we've got at the moment is that it's this time of year, this seasonality, and it doesn't always play out this way, but this is certainly a weaker time of the year traditionally if you look at the long-term averages over, let's say, the last 20 years. And part of the reason for that is liquidity. Summer holidays in America, a lot of people go away, there's a lot less trading activity, lower liquidity, less depth in the market, and it's easier for the algorithms to kick the markets around. And let's face it, we saw yet again that the results from some of the US major trading banks were actually surprisingly good. Now, their general bank performance was really quite poor, but the overall result was great because of their trading activities. The JP Morgans and the Citibanks and those sort of stocks are making money hand over fist trading the market. So they don't really care whether the market goes up or down. They just want movement. And so a lot of these program trading applications are doing just that. They're pushing the market around violently, and the smart money is taking advantage of that. So certainly liquidity is part of it. But the main issue at the moment is there's so many negative triggers combined with an elevated market. So the real question is, how do we deal with that? I spoke about it extensively last week. I refer to it almost every week, and that is there is a process that you can observe that leaves you open to take advantage of the opportunities, but reduces your risk. So, you don't have to be fully exposed to the volatility risk of the market. There are things that you can do to move that to your advantage. Now, last week I also said forget about trading the market, the index. All the focus of the media seems to be on the index. And it's just such a limiting way to think about the market because we've got a market that's very much in two halves. We've got the part that's doing extremely well over the medium to longer term, and that's technology, biotechnology, and similar kind of areas. And we've got the laggards of the market. So, why would you want to have exposure to all of it? That's just limiting traditional thinking. The way to go about it is just to find the best fundamental stocks, the best technical patterns, and just do that. Yes, get some diversification amongst those particular sectors and stocks, but just focus on them. Why not just work with the strength? The strongest stocks in the strongest sectors. It's a process that works, particularly in America, where they celebrate new 52-week highs. Our culture here in Australia is different. But in America, it's people aren't put off by new 52-week highs, stocks breaking out. They rejoice it. And then, of course, you've just got to apply a considered game plan consistently. And I just refer to this over and over and over again. Trading the market is a psychological challenge. It's not so much the process. The process is relatively simple and straightforward. The battle is between our ears, that's for sure. So American stocks was all over the place last week. The S&P rose 1.3%, but the Nasdaq fell almost the same amount. Amazon was down around 7%. I think Netflix was down about 9% on a pretty poor earnings report, I must say. And the Dow Jones actually went up 2.3% because that's some of the old world kind of stocks, the large industrial stocks, and so there was some rotation into the more defensive areas. Now, there's no question that liquidity in the market is a huge driver. There are numerous money supply indicators, but M2 is probably the most widely used. And that money, the M2 money supply is up 25% in the last year, which is the fastest year-on-year growth in history. And for the money supply to go up 25% is it's just a mind-boggling figure. And some of that money is going into the stock market. I don't know what percentage it is, but certainly a significant percentage of that liquidity is not necessarily going into replacing people's lost wages or whatever it may be. It is going into pushing up asset prices, that's for sure. So the algorithms are having an absolute picnic, and you've got to just try and stand aside from that day-to-day fluctuation. So the tricky bit is you can't afford not to react to a significant move like we saw last Monday. And it wasn't just the price move, it was the volume that went with it. The volume was massive, and it was in the market leaders. So you can't afford to ignore that sort of activity, in my opinion. Some people can. Some people can sit back and just let the market do its thing and be looking 1 year, 2 years out. But they're the minority if we end up getting a move into a more significant correction. So, it is a tricky market for that reason. But nevertheless, the trends are still very clear. The opportunities are just everywhere. So it's still a pretty good market to be active in. And the backdrop that we've got is that economic data and earnings per share data, and we've now got the US earnings season underway, are good enough. The stock market is a forward-looking mechanism, and the economic and EPS data are good enough to sustain what's happening in the stock market. And there are also numerous companies, a surprising number of companies, are now starting to raise guidance. And so those companies are going to get rewarded and are being rewarded substantially by the market, because that's what the market wants to see. Companies that are raising guidance are going to be very well supported. Now, the US dollar was slightly lower again, not a great deal, and the 10-year yield was pretty much steady at 0.64. So let's take a look at some charts. So there's the S&P, and part of the reason you can see, so this was Monday of last week, this red candle here. So you can see that we rose on Monday to basically a double top with the high that we had on the 8th of June. And that was a technical level for sure, and the algorithms are working off these technical levels. So the market went up. It was at a technical level where any sort of trigger was going to probably bring in the program trading, and that's exactly what happened. And we saw a significant fall in the last 2 hours. Heavy volume, as I've said, and it was amongst the leaders. If you look at Amazon, Google, Facebook, Netflix, all of those stocks were all hit very, very hard, and so it was something to to pay attention to at such an elevated level. But as it turned out, you can see Tuesday turned around massively, and then the rest of the week was just a lot of indecision that you can see, because the ranges are very small, and the index pretty much closed where it opened. So it opened and closed at the same level, traded up and down a little bit, but it's still basically hugging around this double top level. So I just read it as a market that's moving very much on technical considerations, thanks to the algorithms. Let's look at the Nasdaq. So you can see it really was a very big reversal on Monday in the Nasdaq, and the Nasdaq underperformed throughout the week. Now I just want to show you this is just one example. So this is Zoom, and this isn't a recommendation. It's just cherry picking one of hundreds of stocks that are trending like this that I'm either monitoring or actively trading. So Zoom has had a tremendous period. since, in fact, the price took off in February and never really looked back. It sailed through the crash. It basically went up through the crash. So they're the sort of stocks that that you want to look for. So we're now getting a pullback. So my point here, and you can see that it was a pretty decent reversal on Monday, along with all the other tech stocks. But what we've got here is an incredibly powerful trend that's not only supported technically, but also supported by the fundamentals. You know, the working remote, working from home theme is not going away anytime soon, and that's fantastic for a business like Zoom. And this pullback is now creating an opportunity that we haven't had since probably here, late April. We've got another minor opportunity in late May, and we haven't had an opportunity since then for nearly 2 months. But now we're getting another opportunity. So that's how you need to look at this market, see what's going up really well, and then when the opportunity to get into it under better terms, low, so as the price comes back, you are effectively increasing your potential to the upside, and you are lowering your risk to the downside by definition as the price pulls back. So understand what it is you want to own and have a big enough list so that you can afford to wait for those particular stocks to come to you on your terms. So from a fundamental point of view, I'm monitoring just hundreds and hundreds of stocks. I'm monitoring which stocks are beating guidance, which stocks in particular are raising guidance. I mean, that is absolutely gold-plated for the market to see who's raising guidance. And my overall message is don't be fearful of this market. Embrace the price movements. Use the volatility to advantage, and just maneuver your overall exposure around to suit your particular game plan. And for different people, that means different things. You know, some people are nervous about the market, and so they might want to go to a higher level of cash when we get an event like we had last Monday. Other people are fine with just pretty much sitting where they are. So it's a matter of being clear about who you are as a trader and an investor. Let's just check on the currency. So there is the US dollar. So we really are flirting with support here, and the US dollar could go down further in the short term, which would obviously be a positive for precious metals. The Australian dollar is pretty much the flip side of this, although it is struggling to get through this 70.5 cent area, and we are still in this basic trading range that we've been in since about the middle of last year. All right, while I'm here, let's look at the Australian index. So there's the ASX 200, up a bit over 100 points on the week, but essentially just going sideways. And if we look at the sectors, there's energy. You can see not only two things, not only the fact that it's going sideways, but look at the size of the range of the candles on a day-to-day basis. They've become incredibly small. There's almost no movement at all in the energy sector. Similarly, the finance sector, the day-to-day movement has settled right down, and it's down to a very, very tiny level. Healthcare still moving around a little bit because that's really dominated by 4 or 5 large cap stocks. And materials is trending up, and that's a bit of a global trend that we're seeing. And in the Australian market, the small caps similarly, just really going sideways, and the ranges are getting smaller and smaller. Okay, so just to confirm that, the Aussie dollar just a tick under the 70 cent mark, and 1.9% was our scoreboard for the week. Small cap miners are hot. The capital raising in that sector is there just seems to be an almost insatiable stream of money willing to subscribe to all manner of explorers at the moment. Buy now, pay later is another hot sector, and we're seeing selected technology stocks also. We're seeing some good gains. We're seeing some sharp pullbacks. So significant volatility and therefore opportunity in that sector. Now, moving to the all-important precious metals. Gold was up $11 and finished at $1,811. that was largely around the US dollar. But the trends are unmistakable. Since June of last year, so just a touch over 12 months, gold is up 31%, silver's up 29%. It's now starting to catch up. And GDX, amplifying the move in gold, is up by 71%, which is probably not quite what you'd expect. Normally, GDX would outperform the gold price by 3 to 4 times. So you'd be expecting GDX to be up around about 100%. So it's still got some catch up to do. But look, I've been talking about precious metals since that breakout in the middle of last year, and they haven't disappointed. And the trends are still very strong and very intact. And if you come down to some of the smaller producers, small to mid-cap producers, particularly in America, that are really just starting to get going. They're just starting to break out, and been covering some of those in Portfolio Analyst, but also we've been in some of them in the Insiders Club for quite a few months, and they're all doing very, very nicely. Now, what is driving this, of course, the good part about this is it's not being driven by speculators. We can see that because the number of contracts in the futures market is not up at anywhere near all-time highs in either the gold or the silver markets. But what we are seeing is that the investment demand, which flows into one of two global ETFs, GLD for gold and SLV for silver, and we're seeing that and we can get a readout on how much money is flowing into or out of those ETFs every single day of the week by looking at the holdings. Because as people put more money into those ETFs, then the fund manager has to spend that money and go and buy the underlying metal. So it's backed basically dollar for ounce by physical metal. And we're seeing, not only in the gold market, but also in the silver market, we're seeing very, very strong investment demand. And in fact, the investment demand is accelerating. And it's investment demand that sustains the trend. Speculators start a trend, but they don't sustain a trend. They don't have enough firepower to sustain a trend long term because they're such a smaller component of the market. So this is really, really good news for the precious metals market. And I've been showing you the holdings in GLD last week and also in previous weeks. I just want to note this week that SLV, the holdings are up 9% in a month to 516 million ounces. That is a new record. There's never been that many ounces of silver in SLV before. A 9% increase in a month is absolutely huge, not in monetary terms, but for the fund. And I guess that is the point about silver, that it's, money is continuing to flow into what is a pretty small market in the overall scheme of things. And so if there was a concerted change in attitude towards funds investing in SLV, then it's going to have an outsized impact on the price. And there's certainly strong evidence that this is not speculators, it's fund buying, because the buying, if you look at the day-to-day increase in SLV holdings, the number of ounces being held on a day-to-day basis, it's consistent. And it goes up almost every day, irrespective of whether the silver price goes up or down. So the silver price is going up and down based on short-term activity in the futures market, but the buying is just consistent. And that really is a strong indicator that it's funds. It's not the retail money, because the retail money would be more acutely responding to the day-to-day price fluctuations. So the good thing about fund buying is that they don't tend to go in and out quickly. They're not like speculators. They don't change their mind too readily. So this is really underpinning, I believe, a strong move into these metals that we haven't seen for a decade. So it's all very good news for precious metals. And as I mentioned earlier, we are seeing multiple breakouts in small and mid-cap producers in the States. We're seeing ongoing strength in the Australian producers, but we also are seeing some tremendous breakouts in the developers and the explorers. Now that's a risky part of the market in Australia. It's certainly more risky than the producers, but there are some some very significant moves going on there. So let's just take a look at the gold market. So we'll start with silver. So silver is now butting up against some resistance, this peak that we formed back in September of last year. But if we go all the way back to the last peak, which was in 2011, when silver almost hit $50. Now, we've been in a big trading range since the end of 2013. We haven't broken out of it yet. We need to get above $21, but you can see the rebound since the March lows. It really is quite a sharp rebound. We've gone from $11.75 to $19.37 from the March lows. So that's been a very powerful rebound. We need to clear this level, but as you can see over here, when silver has a habit of, once it really gets going, it really does motor. And you can see here from September 2010, when it broke above that level, went from $21, and by May of 2011, so that's only about 8 months, it had gone from $21 to nearly $50. So a huge run in silver. And you can see with this investment demand, speculators not really in the market yet, that silver still has plenty of upside potential. There's gold on the weekly basis. We've now cleared 1800. So I've been talking about I've been talking about gold and silver since around about here, around about 1380, when we broke out above this level here, was when I really started to point consistently to the precious metals market. And you can see since then it's just gone up very, very sharply from under 1400 to now being above 1800. And if we look at it on a daily basis, you can see there's not too many nasties in that chart. Let's just quickly look at the spread. So this is the ratio between gold and silver. It's still well above the long-term average. The long-term average is about 55 to 1 ounces of silver to an ounce of gold. We're still up at 93. So we've still got, silver can still play plenty of catch up to gold yet. And if we look at GDX relative to the gold price, you can see we're still getting an increase there in GDX. So there is catch up happening, but we've still got a long way to go. And the long-term average for that ratio is somewhere in the mid-40s or mid-0.4 area. So the outlook for precious metals really is particularly encouraging. All right, quickly on other commodities. Copper was up again, another 10 cents or so, and we are seeing improving economic data despite all the doom and gloom about the virus cases spiking again. The economic data is improving, and crude was up about 5 cents. There's the copper chart. You can see it's been a very, very powerful rebound since the March lows. So wrapping it up, the sector rotation causes a bit of short-term discomfort, but it delivers opportunity because we want to be in the strongest sectors and the strongest stocks within those sectors, and they've been hot and it's been difficult to get into them. Well, now they're pulling back. And I don't know when the opportunity will be, but it probably won't be too long. We're probably only, talking days or weeks. Because the trends are so strong that you don't tend to get very much of a pullback. So this is good news. It's a bit, as I said, it's a bit uncomfortable in the short term, but it is very good news. You should maintain the focus on the sectors and the stocks that have got the undeniable tailwinds. And I just constantly reinforce this to members. You need to be very clear about your entry setup. There are two particular types of entry setups that I use, but there are others. But whatever it is you use, just be clear about it and apply it consistently. Portfolio analyst this week, we've got the 2 model portfolios running, and we've just got a heap of other trading ideas. And one of the great things about portfolio analyst is that there are ideas put up by members that are not on my radar. I can't cover the entire market, and members put forward some fantastic ideas that I was unaware of. And once you do the research, then you understand there's some terrific opportunities there. So that's it for this week. If you are not a member or would like more information, there's the website address and also my email address as well. I'm sure it'll be another fascinating week. That's it for today. Cheers.